Real estate investment trusts, otherwise known as REITs, were created as a way of giving investors exposure to real estate assets, particularly commercial real estate, because as you would expect, commercial real estate requires a lot of upfront investment capital to get started. Not only would you need to purchase the land to develop, but you would also need to finance the construction costs involved in developing the land, which is why before REITs, commercial real estate was mostly financed through partnerships, and obviously all partners involved needed to have access to a lot of money. But thankfully for REITs, everyday investors like me and you can invest in these real estate assets. REITs are a trust that investors can buy shares in, and they trade within the stock market just like any other stock. They invest in a portfolio of real estate assets, and investors can participate in its performance by buying shares. So let's look at how a REIT works. Here in Australia, all Westfield shopping malls are owned by a REIT, and the management team in charge of that REIT are in charge of any repairs that may be required, and they also need to manage the leasing responsibilities for all the retail stores inside each shopping mall, and that each shopping mall is producing revenue, or more importantly, turning a profit through the lease they charge to its tenants. And any costs that are involved in the maintenance repairs or any debt that the REIT might be liable for is deducted from the revenue, and what's left over are the earnings. Now, every country has different laws surrounding REITs, but it's not uncommon for REITs to pay out 90% of its earnings to its shareholders in the form of dividends. But REITs are unfranked, meaning they are usually taxed at a higher rate compared to most stocks, and most REITs pay out dividends every quarter. And if investing in REITs is something that you are interested in, then you should look to invest with a long-term strategy. But just like any investment you make, REITs do still carry risk. If they are over-leveraged, meaning they have taken out a lot of debt to maybe expand and to build more shopping malls, but management have a tough time leasing out the retail space, and the rent they currently collect from its tenants isn't enough to cover the loan repayments on the debt they used to build more shopping malls, well, that's obviously a red flag, and it would probably be a bad investment. So you need to do your research on what REITs you are investing in, as you would any investment you make. Now, there are different types of REITs, and the REITs we just discussed, which are heavily invested in commercial real estate, they are what's known as equity REITs. For the next part of this video, I will discuss mortgage REITs, otherwise known as MREITs. MREITs provide financing for real estate assets, and they generate revenue through the interest they charge to their mortgage holders, and also by purchasing and originating mortgages and mortgage-backed securities known as MBS. Some MREITs invest in residential real estate, and others invest in commercial real estate, and there are also MREITs that are diversified into both residential and commercial real estate, as well as holding mortgage-backed securities, providing diversification for its shareholders. Mortgage-backed securities are a group of mortgages issued by banks and are bundled together in the form of a single bond. And mortgage-backed securities are compared to bonds due to being backed by the government, and just like MREITs, some mortgage-backed securities are either invested in residential or commercial real estate, and sometimes both. Investors in mortgage-backed securities receive periodic payments similar to bond coupons. Now, some MREITs also offer construction loans and make money from the interest they charge on the loan while using the real estate asset that's under construction as collateral on the loan. And just like equity REITs and stocks, MREITs trade within the stock exchange and can be bought and sold through your online brokerage account. There are also ETFs and mutual funds dedicated to MREITs. With every investment you make, you need to do a sufficient amount of research before you invest. Real estate, for the most part, has always been a safe investment. Real estate financing can be a good investment too, because even if the mortgage REIT is heavily leveraged, the real estate asset that it's leveraged against can be used as collateral, and you would expect the management team of that mortgage REIT to only leverage money against real estate assets that exceed the valuation of the money they lend. For more videos on all things investing, subscribe to this channel.